Welcome to Global Risk Community Chat. Today, our guest is Paolo Laureti. I'm very happy to have you here today, Paolo. Welcome.
Thanks for having me.
Likewise. So before we get into our topic for today, can you briefly introduce yourself to our audience?
My name is Paolo Laureti. I live in Rome, and I'm a risk professional. I started out as a theoretical physicist, actually. I obtained a Ph.D. and worked as a researcher in academia for a few years, but I was an atypical one. My research topics included recommender systems, the role of information in economy, and also statistical finance and portfolio optimization. So that's how, about 15 years ago, I transitioned to financial engineering for a consulting company, and today I am the product manager for financial risk solutions for insurance at SS&C Algorithmics, which is one of the major providers of financial risk management software globally.
Sounds good. Sounds like an interesting transition as well. So with that being said, then let's get into our topic. What would you like to share with us today?
So I deal with financial risk management in the insurance sector, and particularly with enterprise-wide risk management, in short, ERM. In this context, ERM means a framework to identify different risks and act upon them according to a set of business objectives. Now, our starting point usually is market risk, and then possibly we also model credit risk jointly in an integrated way. And then other risk types can also be added to the picture, such as liquidity risk or climate risk, right? Emergent types of risks. And the ultimate objective is to aggregate correlated risks under stochastic scenarios to anticipate extreme events and try to avoid the worst consequences of those events. So ERM helps establish a risk culture within the insurance firm. It supports on one side the actuarial and finance teams, on the other side the asset liability management and investment functions. So it is essential to make an insurance business more resilient, but also potentially more profitable. And a solid ERM also fuels the positive function of that insurers play within society. So insurance companies manage our risks, and so they better take care of theirs to begin with. If we look at it from a systemic level, insurance helps addressing some of the main challenges ahead of mankind. It may seem an exaggeration, but think of fighting inequalities and poverty, or guarantee stability to an aging population, especially in the Western world, or ensuring a solid economic growth, or help mitigate climate risks, which is a huge thing today. And all these tasks are facilitated by a risk-aware insurance practice.
Thank you for sharing that. Actually, indeed, it's like a very important, very crucial topic that maybe not talked about much, but what would be some key things when it comes to implementing an effective ERM, perhaps into the insurance industry? So what would be some key things in general about this?
Well, of course, the first thing is good data, right? So garbage in, garbage out. So the data issue is huge. But the main entry point for large insurance groups to implement an ERM framework, well, from an historical perspective, it comes from regulators, right? After the 2008 financial crisis, prudential authorities started thinking of new ways to avoid a similar snowball effect next time an extreme market crisis occurs. So the idea of placing risk at the center of an insurance business began to make its way. A pioneering role was played by the European supervisor with Solvency II, which was a new principle-based prudential regulation which came into effect in 2016. From a quantitative perspective, Solvency II established a risk-based capital framework that requires firms to set aside enough capital to cover 1 in 200 events. From a technical perspective, that is, they need to calculate value at risk 99.5%, over the 1-year time horizon of their entire balance sheet. And after Europe, other geographies followed. So the way we help insurers achieve these objectives are, first of all, we model assets natively by terms and conditions. So data is the first point, and good market data is one issue, but that is easily solved. On the liability side, what we do is we proxy the liabilities and model them on the basis of a common risk factor universe. So we have a consistent representation of assets and liabilities in a market consistent balance sheet. And then we can run very large Monte Carlo simulations. If you want to spot the tail of the distribution and look at quantifying risk and look for disruptive events, you need large simulations. Once we understand what could hurt a firm's solvency capital, what scenarios are more critical, it is then possible to, for instance, rebalance your asset allocation to reduce risks and increase returns. So ERM is essential beyond regulatory compliance, although the first driver was came from regulators, right? But it does enable risk-aware management of the firm, and ultimately, it improves the protection of the policyholders. And more broadly, it preserves, ERM helps preserve the insurance sector at large. So what one might ask, why is insurance and insurance risk that essential to society, right? I mean, if you want, I can go over a couple of reasons why that is the case.
Yeah, maybe that would be a good one also to maybe merge with some takeaways. So if you could go towards it with, like why it is necessary, why is it essential, and what can the the audience take away from it, basically, in that kind of a way, it would be amazing.
Right. So if you think of challenges like climate risk or others, the role of insurance is essential in this period of transition. First of all, insurers are underwriters, so they mitigate the effects of exogenous events over which we have no control, such as illness, accidents, disasters, or loss of wealth. And the way they do that is by distributing the burden in an equitable manner across all the policyholders. In terms of climate risk, business insurance underwriters can favor the flow of capital to mitigation projects over high impact sectors like the fossil fuels. So they absorb individual and companies' risks, and they set the conditions for economic growth, such as to buy a house or start a business. So they kind of stabilize finance and societies, and this stabilizing factor is also reinforced by their role as an institutional investor. So insurers are huge institutional investors, and unlike others, they look at the long time horizon, so they can finance long-term projects to cover their long-term liabilities. So one takeaway is that first, insurance ERM allows to not cancel risk, but take the good risks, right? So to align investments with the risk appetite framework of the firm, and that means that it might seem counterintuitive, but we want to take the good risk and catch the opportunities.
Thank you for sharing that as well. I think it was also very good takeaway point that people can already start thinking about, take some actionable steps towards as well. So with that being said, I want to thank you again for joining us today, sharing your insights on insurance industry, as well as the ERM risk, financial risk, and all of these. So thank you so much.
Thank you, Adja.
Have a lovely day.
You too.